Ladies and gentlemen, welcome to another educational video brought to you by the Trader24 team. In this video, we will present a fundamental risk management rule used by day traders called the 1% rule. Applying the rule keeps capital losses to a minimum when an investor has a bad day or when market conditions are difficult. The 1% rule is useful for many reasons, and you can benefit from understanding and using it as a part of your trading strategy. The 1% rule limits losses for any particular transaction to 1% of the total account value. Investors can risk 1% of their account by opening either big positions with nearby stop losses or small positions with stop losses placed far away from the opening price. The target profit on these trades should be at least 1.5% or 2%. It is a general rule of thumb, and some investors may risk a little more, while investors with a large account may risk less than 1%. Following the rule means that you will never risk more than 1% of your account value in a single transaction. This does not mean that if you have a trading account of 30,000 euros, you can only buy 300 euro worth of shares, which would be 1% of 30,000. You can use all your capital in a single transaction or more if you use leverage. Applying the 1% rule means that you take risk management measures to prevent losses of more than 1% on any single transaction. No one wins on every trade, and the 1% rule protects your capital from a significant drop in adverse situations. If you risk 1% of your account balance in each transaction, you will have to lose 100 consecutive transactions to reset your account. You can use the 1% rule for day trading in stocks or other markets such as futures or Forex. Suppose you want to open a position in the Euro-USD rate and your account balance is 30,000 euros. Depending on the size of the position you open, the stop loss will be set at such point that the loss will not exceed 300 euros, which is 1% of your account value. With a very small position, for example 0.1 lot worth 10,000 euros, the stop loss should be at 350 pips. Example long at 1.1800, stop loss at 1.1450. For a one lot position worth 100,000 euros, the stop loss should be set at 35 pips. Example long at 1.1800, stop loss at 1.1750. The calculation is made as follows. Number of pips equals loss divided by pip value divided by lot. For Euro-USD rate, the pip value is $10 or 8.5 euros with the exchange rate at 1.18. So we have 300 divided by 8.5 equals 35.3 divided by one lot equals 35.3, which we round up to 35 pips. This method applies to all markets. You should also take into account the slippage that can occur when executing the stop loss, which means that you could have a larger loss than expected. Investors with trading accounts under $100,000 usually use the 1% rule. While 1% offers more security, some investors increase it up to 2%, risking up to 2% of their account value per transaction. For accounts over $100,000, investors usually risk much less than 1%. Due to the size of the account, the positions that need to be opened are very large. The 1% rule can be modified to suit the size and market of each investor's account. Set a percentage that you feel comfortable risking and then calculate your position size for each trade according to the opening price and stop loss. Before you risk any money, even 1%, practice your strategy in a demo account and work on getting steady profits before investing real capital. Thank you for watching this educational video. Stay tuned to trader24.co.za for our next videos. Trade the global markets with HF Markets. Open a live account at hfeu.com.